about what we can expect today and the meetings ahead. Joining us, Stephanie Roth, chief economist at Wolfe Research, along with Larry Adam, chief investment officer at Raymond James, and Andrew Szczurowski, strategic income portfolio manager at Morgan Stanley Investment Management. I think that is full team coverage. Andrew, we'll begin with you. What is your expectation from the Fed today? And more importantly, what do you want to hear them say?
No, thanks for having me. I think, look, the expectations are low for what happens today. We're not expecting any rate cut from the Fed. I am expecting to see 2 dissents, as Steve was just mentioning. I think the more importantly is going to be the press conference. And what everyone's looking to see is what does Powell essentially kind of hint that a rate cut is coming in September? I think he's ultimately going to want to keep that optionality open. I think, look, we have 2 more payroll reports between now and that September meeting. I think ultimately, if we get weaker reports in the next 2 months, then the Fed's going to be cutting at that September meeting. But everything's going to hinge on the labor market, in my view. Even though inflation's above their current kind of 2% threshold, I think that these kind of opposing dichotomy of views between inflation and the labor market are going to eventually swing the Fed to side with the labor market and cut, even if inflation's above where they would like it to be.
I feel like, Stephanie, it's like the end of the beginning, if you will, where today, this meeting, this decision marks what is likely to be maybe changes in meetings to come. We know the Federal Reserve Chair himself will likely change next May. That seems to be a given. All that said, what are you and your team expecting from the Fed, not just today, but the rest of the year?
Yeah, I think that they're not going to be able to cut this year. I think we're going to be in an environment where inflation ends up being fairly sticky. We just in the last print started to see the effects of the tariffs weighing on the data. We think that's going to be very much the case for the next couple inflation readings, where inflation is going to be sitting well above 3%. The unemployment rate is going to be likely steady around 4.1, 4.2. And that's a tough backdrop for the Fed to be cutting in September, in which case the economy's way too strong and inflation is a little bit too elevated, which keeps them on hold.
You know, Larry, I don't want to speak for all your clients there at Raymond James, but I'm going to speak for all your clients there at Raymond James. I think they care less about what the Fed says and does and how it affects them, right? How does it affect stock prices? How does it affect mortgage costs? How does it affect the retirement with fixed income and bond yields and whatever it may be? What is the best outcome for Raymond James's clients from today's meeting and press conference?
Well, I think you bring up a good point. I mean, we sit here and argue whether or not there's going to be a cut today or September or the end of the year. And the bottom line is what actually happens to the economy. Because as long as this economy remains on steady footing, that'll be a positive for the equity markets and continue to see earnings go higher. Now, our base case is ultimately, though, that they do cut twice this year because we do see that the economy is slowing. And while you do see some froth, if you will, in the markets, because you've seen the equity markets rally, you've seen meme stocks rallying, you've seen high yield spreads at, pretty historic lows. I mean, that is a sign of easing financial conditions. But if you strip out what's happening, particularly in the tech space and AI, I think there's a large part of this economy that is actually struggling, right? I mean, when you look at small businesses, and when we talk to small businesses here at Raymond James, they're struggling because their interest rates to get loans are like 9% or so.
Yeah, so sorry to interrupt, Larry, but I think you're making a critical point, and I want to go more into that because I tweeted out earlier today, listen, I travel all around the country. My parents live in rural Virginia. I go to rural Wisconsin all the time. People are largely struggling, and if they got an income increase, okay, if they were lucky enough to get a raise, a lot of that money is just sort of, I was going to say something, is spent on auto insurance, medical bills, whatever it may be, things the Federal Reserve can't control. But what the Fed can control is trying to lower costs for other things to balance it out. Will we get that? Will the Fed offer some help and relief somehow to the middle-class American family?
Well, that's why we think you're going to see at least two, or you're going to see 2 cuts this year and then more next year. Because to your point, we think that this economy needs to broaden out besides just what's happening in the AI space, right? I mean, it's interesting that you bring up, people are the wealth effect, right? We were talking about it today on one of our calls. The wealth effect, it's only about 3 cents, 4 cents for the amount of money that gets made in the equity market, right? And that's helping the higher end. But if you can actually reduce people's costs, if you can get more job growth at a steadier pace than where it is right now, because we're really only creating jobs, not really in the private sector currently, We need to get more of that to get people on a better place going forward in this economy.